A company issues stock as its primary means of raising business capital. Investors who buy the stock buy a share of ownership in the company's net worth. Whatever a business owns, its assets, less its creditors' claims, its liabilities, belongs to the business owners, its stockholders. Each share of stock entitles its owners to a portion of the company's profits and dividends and an equal vote on directors and other important matters. Most corporations are organized in such a way that their stockholders regularly vote for and elect candidates to a board of directors to oversee the company's business. By electing a BOD, stockholders have some say in the company's management but are not involved with the day-to-day details of its operations. An individual's stock ownership represents his proportionate interest in a company. If a company issues 100 shares of stock, each share represents an identical 1/100th or 1% ownership position in a company. A person who owns 50 shares of stock owns 10% of the company. A person who owns 50 shares of stock owns 50% of the company. Common stock. Corporations may issue two types of stock, common and preferred. When speaking of stocks, people generally refer to common stock. Preferred stock represents equity ownership in a corporation, but it usually does not have the same voting rights or appreciation potential as common stock. Preferred stock normally pays a fixed semi-annual dividend and has priority claims over common stock. That is, the preferred is paid first if a company declares bankruptcy. Common stock can be classified as authorized, issued, outstanding, and treasury. Authorized stock refers to a specific number of shares the company has authorization to issue or sell. This is laid out in the company's original charter. Often, a company sells only a portion of the authorized shares to raise enough capital for its foreseeable needs. The company may sell the remaining authorized shares in the future or use them for other purposes. Should the company decide to sell more shares than are authorized, the charter must be amended through a stockholder vote. Issued stock has been authorized and distributed to investors. When a corporation issues or sells fewer shares than the total number authorized, it normally reserves the unissued shares for future needs, including raising new capital for expansion, paying stock dividends, providing stock purchase plans for employees or stock options for corporate officers, exchanging common stock for outstanding convertible bonds or preferred stock, or satisfying the exercise of outstanding stock purchase warrants. Authorized but unissued stock does not carry the rights and privileges of issued shares and is not considered in determining a company's total capitalization. Outstanding stock includes any shares that a company has issued but has not repurchased. That is, stock that is investor-owned. Treasury stock is stock a corporation has issued and subsequently repurchased from the public. The corporation can hold this stock indefinitely or can reissue or retire it. A corporation could reissue its treasury stock to fund employee bonus plans, distribute it to stockholders as a stock dividend, or under certain circumstances, redistribute it to the public in an additional offering. Treasury stock does not carry the rights of outstanding common shares, such as voting rights and the right to receive dividends. By buying its own shares in the open market, the corporation reduces the number of shares outstanding. If fewer shares are outstanding and operating income remains the same, earnings per share increase. A corporation buys back its stock for a number of reasons, such as to increase earnings per share, have an inventory of stock available to distribute as stock options, fund an employee pension plan, and so on, or use for future acquisitions. Thanks for listening and learning about what is a stock. Follow WikiBusinessFinance for more intel on finance.